Picture this, January 26th, 2026. A massive winter storm sweeps across the eastern seaboard. Natural gas prices at Henry Hub spiked to over $30 per MMBTU, the highest single-day price in years. And right in the middle of that polar vortex, EQT Corporation, the largest natural gas producer in the United States, had its pipelines running at full capacity. Lana. This was the setup for one of the most impressive Q1 earnings reports in the entire energy sector.
And the numbers absolutely delivered, Hudson. EQT reported adjusted earnings per share of $2.33 for the first quarter of 2026, beating the street's estimate of $2.08 by 12%. Revenue came in at $3.4 billion, up 39% from Q1 2025. And production volumes of 618 billion cubic feet equivalent, 618 BCFE, came in above the high end of management guidance.
618 BCFE above the high end of guidance, and CapEx of $608 million, 4% below the low end of their own guidance. That combination, producing more gas than planned while spending less money than planned, is the EQT story in a sentence. In natural gas E&P, that kind of dual outperformance is exceptional.
And when you translate that operational execution into cash generation, the result is record free cash flow for the quarter. EQT used that cash to pay down $2.3 billion of debt in a single quarter. That is not incremental progress on the balance sheet. That is a step change. Net debt dropped from $7.7 billion at year-end 2025 to $5.4 billion in just 3 months.
That is a company operating at peak performance on every dimension. But before we break down the quarter in detail, let us set the stage and talk about who EQT Corporation actually is and what they do.
EQT Corporation was founded in 1878, originally as Equitable Gas. The company is headquartered in Pittsburgh, Pennsylvania, and today operates as the largest natural gas producer in the United States by production volume. EQT's core operating territory is the Appalachian Basin, primarily the Marcellus and Utica shale formations in West Virginia, Pennsylvania, and Ohio.
The business model is fundamentally about drilling wells in those shale formations, extracting natural gas and natural gas liquids, and selling that gas to utilities, industrial customers, LNG export terminals, and power generators. It is an upstream extraction business with massive fixed cost leverage to the price of natural gas.
The biggest strategic inflection point came in July 2024 when EQT closed its acquisition of Equitrans Midstream, creating what management calls a supermajor of Appalachian natural gas. EQT now controls the wellhead, the gathering lines, the compression stations, and the transmission pipelines. It is the only fully vertically integrated natural gas company in the Appalachian Basin.
That vertical integration is the structural moat. When you own the full logistics chain from wellhead to delivery point, you eliminate third-party gathering fees, you can optimize flow rates across your entire system, and you protect your margins through commodity cycles in ways that pure-play upstream producers simply cannot.
The timing of that integration is strategically significant. U.S. LNG export capacity is projected at 17 billion cubic feet per day in 2026. That structural demand for Appalachian natural gas from buyers in Europe and Asia who need reliable supply creates a multi-year demand floor that benefits EQT's production volumes.
And EQT can meet that demand profitably at almost any gas price environment. The company's combined NYMEX unlevered free cash flow break-even is approximately $2 per MMBTU. When Henry Hub averages $3.70, as it did in Q1 2026, EQT's margin profile is extraordinary. That $2 break-even is the heart of the competitive story.
Scale, vertical integration, and a cost structure that generates cash at almost any gas price. That is the EQT platform. And the company is being led by a CEO who engineered that transformation from the inside. Being led by Toby Rice since July 2019, let us talk about the leadership.
Toby Rice became president and CEO of EQT in July 2019, following one of the more dramatic proxy battles in recent energy history. Rice and the founding family of Rice Energy, the company they built and sold to EQT in 2017, returned and won control of the board they had previously sold the company to. It was a statement of conviction that the old EQT could be fundamentally transformed.
What Rice did after taking over is remarkable. He cut unit operating costs by over 40% in the first 3 years. He modernized the drilling program into one of the most efficient in Appalachian history, and then he orchestrated the Equitrans acquisition, a landmark deal that created the only fully integrated natural gas platform in the basin. Each piece of the transformation thesis has delivered.
After the Q1 2026 results, Rice said directly, and I am quoting here, EQT delivered outstanding operational and financial performance in the first quarter, generating record free cash flow while continuing to strengthen our balance sheet. That is a CEO describing results that match the rhetoric.
Rice has also established EQT as an environmental leader in the natural gas industry. The company has reduced its methane intensity by over 60% since 2018, which matters increasingly for institutional capital that screens on environmental criteria. EQT wants to be the natural gas company that sustainability-conscious institutions can own with confidence.
Strong leadership with a track record of delivering exactly what was promised: lower costs, higher volumes, vertical integration. Now let us dig into the financials and see what all of that translates to in numbers.
EQT is trading at $56.92 per share. Market cap of $35.5 billion. The stock trades at 10.6 times trailing 12-month earnings, 5.5 times enterprise value to EBITDA, and 3.5 times price to sales. For a company with this level of cash generation and balance sheet improvement, those are not stretched multiples by any energy sector standard.
Revenue for Q1 2026 came in at $3.4 billion, 39% above Q1 2025. That growth rate reflects both the Equitrans volumes now flowing through the combined entity and the higher gas prices driven by winter storm demand. The sequential acceleration from Q4 2025 is dramatic.
On earnings, adjusted EPS of $2.33 versus the $2.08 estimate, a 12% beat. GAAP EPS of $2.49, slightly above adjusted due to mark-to-market gains on hedging positions. The 12% adjusted beat is clean outperformance, volumes above guidance, prices above forecast, costs below guidance.
The balance sheet transformation is the headline story of this quarter. Net debt dropped from $7.7 billion at year-end 2025 to $5.4 billion at the end of Q1, a $2.3 billion reduction in a single quarter. Fitch recognized this improvement during the quarter and upgraded EQT to BBB investment grade status.
Looking at the income statement, EBITDA of $2.7 billion for the quarter, operating income of $2.04 billion, net income of $1.55 billion. The operating margin at 47% reflects the efficiency of the vertically integrated model. EQT keeps nearly half of every revenue dollar as operating profit.
Cash on hand, $327 million. Total debt, $5.7 billion. Interest expense is being managed down as they pay off higher cost tranches with free cash flow. The Fitch BBB upgrade gives EQT access to investment-grade credit markets, which further reduces the cost of any future refinancing.
The margin profile tells the full efficiency story. Gross margin of 64%, operating margin of 47%, net margin of 33%. These are strong numbers for any sector, and for a natural gas producer, they reflect the cost structure that Toby Rice's team has built over 5 years of relentless operational discipline.
On production, 618 BCFE for Q1, above the high end of their own guided range. CapEx of $608 million, 4% below the low end of guidance. Realized price of $5.08 per MFE on a sales-weighted basis. Every operational metric came in better than the company itself had projected.
Full year 2026 guidance, production of 2275 to 2375 BCFE, and capital expenditure of $2.65 to $2.85 billion. At those production levels and current gas prices, management's free cash flow guidance of approximately $3.5 billion for the year is credible, even conservative given Q1's outperformance on both volume and cost.
$3.5 billion in annual free cash flow against a $35.5 billion market cap implies a free cash flow yield of approximately 10%. That is the number long-term investors care about most. 10% FCF yield means the company can retire its remaining net debt in roughly 18 months at that pace.
The Equitrans acquisition also changed the cash flow profile fundamentally. Pre-deal, EQT was purely an upstream producer with all the commodity price volatility that implies. Post-deal, the midstream segment contributes fee-based cash flows that are relatively price-insensitive. The blended portfolio is more resilient through commodity cycles.
On capital returns, EQT's dividend is currently modest, approximately 33 cents per share annually, a yield of around 0.6%, with a payout ratio of just 6%. Management is explicitly prioritizing balance sheet repair over dividends and buybacks right now, which is the right call when you are retiring over $2 billion in debt per quarter.
Overall, EQT's financial health is strong, record free cash flow, a balance sheet improving faster than any model expected, Fitch investment-grade credit, and full-year guidance that implies sustained cash generation at current gas prices. What does Wall Street make of all of this?
The investment community is broadly constructive on EQT. The consensus sits at approximately 20 buy or outperform ratings, 7 holds, and 0 sells. The average price target is around $68.50, which implies roughly 20% upside from the current price of $56.92.
The high conviction targets are noteworthy. BMO Capital Markets raised their price target to $76 with an outperform rating after the Q1 beat, one of the more aggressive calls. Stevens has a $73 target. Even the more measured coverage generally sees meaningful upside from current levels.
The upgrade cycle has been driven by the EQT transformation narrative. Costs down, volumes up, Equitrans integration delivering synergies ahead of schedule, and the Fitch investment-grade upgrade adding institutional credibility. Each positive development brings in a new class of institutional buyers who could not previously hold the stock.
The Q1 earnings report was received positively. Revenue of $3.4 billion against an estimate of approximately $3.25 billion. Adjusted EPS of $2.33 against the $2.08 estimate. Management guided for continued free cash flow generation through the remainder of the year, and that guidance was taken as credible given Q1's outperformance on every metric.
The key detail in the guidance reception was the conservatism. If Q1 came in above the high end on volumes and below the low end on CapEx, there is a reasonable case that the full-year guidance has embedded upside. That is the kind of setup where a beat-and-raise cycle becomes a repeating pattern through the year.
With ratings broadly constructive and price targets sitting well above the current stock price, let us lay out the bull case and bear case for EQT. Starting with the bull side.
The bull case for EQT starts with a convergence of extraordinary operational execution and structural macro demand that is unlike anything the natural gas sector has seen in years.
Bull point 1. Record free cash flow against a near unbeatable cost structure. EQT's unlevered free cash flow break-even of $2 per MMBTU means that at Henry Hub prices of $3.70, the company generates exceptional margins on every molecule it produces. The $2.3 billion in Q1 debt reduction was funded by genuine free cash flow, not asset sales or financial engineering.
Bull point 2. Structural LNG export demand. The United States is on a multi-year trajectory of expanding LNG export capacity, and Appalachian natural gas sits at the most logical supply point for that export demand. EQT is not just selling gas to local utilities. It is supplying the global energy market at a moment when demand for reliable natural gas supply has never been higher.
Bull point 3. The Equitrans integration is delivering. The $425 million or more in identified annual synergies from the acquisition come from gathering fee elimination, compression optimization, and shared overhead reduction. These are real savings from a combined entity that no standalone upstream producer could replicate. The vertical integration thesis is working.
Bull point 4. Investment-grade credit status. The Fitch BBB upgrade during Q1 is not just a rating change. It expands the universe of institutional buyers who can hold EQT securities, reduces financing costs on any refinancing, and validates the balance sheet trajectory management committed to when they announced the Equitrans deal.
Bull point 5, management execution has been exceptional. Every metric they guided to in 2024 and 2025 has been met or beaten. When a CEO consistently delivers above guidance on volumes, below guidance on CapEx, and ahead of schedule on synergies, you give him the benefit of the doubt on the 2026 free cash flow projection.
That is a genuinely compelling set of positives. Lana, what is the bear case?
The first and most important bear point: commodity price risk. EQT's financial results are directly and powerfully linked to the price of natural gas. The exceptional Q1 results were significantly driven by Winter Storm Fern pushing Henry Hub to elevated prices through January. Summer and shoulder season gas prices are historically weak. If Henry Hub averages $2.50 or below for 3 consecutive quarters, EQT's free cash flow generation decelerates materially.
Bear point 2, tariff-driven cost inflation. EQT operates heavy industrial equipment, drilling rigs, compression units, gathering infrastructure, pipeline materials that involve significant steel and manufactured components. With elevated tariffs on imported materials, both the CapEx budget and ongoing maintenance costs face upward pressure that the current guidance may not fully capture.
Bear point 3, Equitrans integration execution risk. The combination of a major midstream infrastructure company with a large upstream producer creates organizational complexity. The $425 million synergy target is a management projection. Actual realization could take longer or fall short of the target if integration challenges prove more stubborn than anticipated.
Bear point 4. The stock at 10.6 times trailing earnings and 5.5 times EBITDA already reflects meaningful improvement from the distressed levels of 2023. If natural gas prices revert toward the sub-$2 range of recent years, both the earnings and the multiple compress at the same time. That is the double compression risk that makes energy investing difficult.
And bear point 5, residual debt burden. Even after the Q1 paydown, EQT carries $5.4 billion in net debt. If free cash flow generation slows due to gas price weakness or a CapEx overrun, that debt becomes a constraint on capital allocation and a source of financial risk.
Natural gas investing always comes back to conviction on the commodity. The bull case is genuine, but so is the commodity risk. Both sides have real merit.
Fair enough. Let us look at how EQT stacks up against its natural gas production rivals.
EQT trades at a price-to-sales ratio of 3.54 times, representing a clear premium to other Appalachian natural gas producers. The premium is deliberate. EQT is the scale leader and the only fully integrated midstream-upstream platform in the basin. The market is willing to pay up for that combination.
The most natural comparison is Antero Resources, ticker AR, which shares EQT's Appalachian focus and significant natural gas liquids exposure. Antero trades at roughly 2.5 times sales. The discount to EQT reflects Antero's smaller scale and its reliance on third-party midstream services for gathering and transmission.
Range Resources, ticker RRC, is another Marcellus-focused producer trading at roughly 2.2 times sales. Range has a strong track record of low-cost production, but it lacks the midstream integration that defines EQT's cost advantage. Third-party gathering fees that Range pays are revenues that EQT now captures internally through the Equitrans system.
CNX Resources brings similar Appalachian DNA, but has shifted to a capital return-first strategy focused on buybacks over growth. CNX trades at roughly 1.8 times sales. The discount reflects lower growth ambition and smaller scale. CNX is a different investment proposition entirely, more of a capital return story than an operational transformation thesis.
The picture that emerges: EQT commands a premium multiple as the scale leader with the integrated midstream advantage. At 3.5 times sales versus 1.8 to 2.5 for its Appalachian Basin rivals, the market is pricing in EQT's transformation and the Equitrans integration upside.
EQT's scale advantage is clear in that comparison. Now, before we close the fundamental analysis, let us look at what the options market is telling us about near-term expectations for EQT.
Implied volatility is sitting at the 39th percentile post-earnings, relatively subdued for an energy stock that just reported a significant beat. When implied volatility is below the 50th percentile after earnings, It suggests the market views the result as a confirmation of the existing trajectory rather than a surprise that changes the narrative.
The put-to-call open interest ratio of 0.61 is meaningfully below 1, signaling a bullish option setup. Call open interest substantially exceeds put open interest, which means more market participants are positioned for upside than downside protection from current levels. The volume ratio of 0.42 confirms the bullish bias.
Call open interest is concentrated at the $65 and $70 strikes. That aligns directly with the range of analyst price targets. Put protection clusters around $50 and $47. The options market is collectively positioning for a move toward the upper end of the target range, with downside protection focused on the $50 to $52 support zone.
On insider activity, CEO Toby Rice has made no open market purchases or sales in over 18 months. At a $35 billion energy company, executive compensation is structured through multi-year performance equity programs tied to operational and financial targets. The absence of discretionary trading is a neutral signal.
There was one notable transaction. Executive Vice President Sarah Fenton sold 3,768 shares on February 20th at approximately $52 per share. At that price level, below current trading, the sale reads as routine portfolio management rather than a negative signal about business trajectory.
The options market is pricing upside, insiders are in neutral territory, and the fundamental momentum is clearly positive. Let us get to the bottom line on EQT Corporation.
The key metric to watch for EQT is the Henry Hub natural gas spot price. That single number drives more of EQT's earnings, free cash flow, and debt reduction capacity than any other variable. At $3.70 per MMBTU, EQT is generating exceptional cash. At $2.50, the free cash flow story is modest. Below $2, the debt reduction trajectory slows materially.
The investment thesis rests on three pillars. First, the operational transformation under Toby Rice that has made EQT one of the lowest-cost gas producers in the country. Second, the Equitrans integration delivering fee-based revenue that smooths cash flows through commodity cycles. Third, structural LNG export demand creating a multi-year demand floor for Appalachian natural gas.
The risk framework is equally clear. Commodity price volatility is the dominant risk. Natural gas is notoriously cyclical, and a single weak season can meaningfully reduce quarterly cash generation. Integration execution on the Equitrans synergies carries delivery risk, and residual debt of $5.4 billion limits capital allocation flexibility if conditions deteriorate.
The near-term catalyst is straightforward: natural gas prices through summer 2026. If Henry Hub holds above $3 as LNG export demand absorbs growing U.S. supply, EQT's free cash flow generation continues at a pace that validates the deleveraging story and the price targets. That is the thesis checkup for the next 90 days.
At $56.92 with a free cash flow yield of roughly 10% and a balance sheet improving faster than any energy company in recent memory, EQT represents a compelling risk-reward if you have conviction on natural gas prices holding at supportive levels. The Fitch upgrade, the record Q1 results, and Toby Rice's execution track record give you a solid foundation.
Three metrics I would track for the next 2 quarters: Henry Hub average price, production volumes relative to the guidance range, and net debt trajectory. If volumes stay above guidance, CapEx stays below guidance, and net debt continues declining toward the $4 billion range, the thesis is firmly on track.
That is EQT Corporation in full, from the Marcellus Shale to the LNG export terminals, from the $2 break-even to record free cash flow. Before we sign off, Lana has a quote that captures the moment perfectly.
Toby Rice himself said it best: "Clean, reliable energy is not just an environmental imperative, it is an economic one. That is the bet on natural gas, and EQT is making it at scale, with a cost structure and balance sheet to back it up."
A CEO who sees natural gas as both the right economic bet and the right environmental transition. That is a rare combination of conviction and clarity. That is going to do it for episode 181 of Charged Alpha, our deep dive into EQT Corporation. And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities, No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I am Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.